D-Street Chatter. But before that, let's get chatting with our Alpha Manager of the day. Ajay Vora of Nuvama Asset Management is joining us on the show. Hi Ajay, thanks so much for joining in. Ajay, plenty of pessimism, but sometimes these sort of scenarios throw up the best opportunities. What are you all doing as of now in terms of money allocation? And do you believe post this 10% correction on the headline index, that's the Nifty, but the broader markets have corrected far more? Time to allocate more money?
Yeah, so thanks, Nigel, for having me on the show. So honestly, at this point of time, tactically, we have increased our long exposure in the market. And there are a couple of reasons to that. So one is actually, if you look at it, we are in a similar phase to what we were in June 22, which is last year. At that point of time, in a quarter's time, market was down almost 10%, and short positions were also quite significant. And if you look at, the current period over last 4 months, which is from December till March right now, markets are again down almost 10%. But the short position has been almost 2x of what it was at that point of time. Adding to that, if you look at, India's performance within emerging market, we have given away large part of the outperformance. So if you look at over last 6 months, MSCI EM is flat, whereas India is down almost 6%. And in fact, MSCI World is positive 4%. So to a very large extent, there has been a massive shorts in the system, as well as our underperformance is also pretty significant. So I'm not saying that, we are completely out of the woods, but tactically, I think we are set for maybe, a decent bounce post the year end, post this whole 31st March liquidation, which is going on. We can see some sort of bounce in the first week or so.
So new financial year will bring new tidings. That's what Ajay is telling us. Hopefully. Ajay, good afternoon. Which areas to get in to position yourself for that bounce, or what's looking good? Because in the broader market, so much has seen so many sectors, so many stocks have seen so much damage. The field is open, but one has to be careful.
So honestly, Prashant, it's not that, the worst is completely behind us, because I think as we discussed last time, we have to live through this narrative of slowing growth. And it actually is transpiring from the global markets. So actually, I strongly feel that the damage is already done by the Fed in terms of aggressive rate hikes. And now we are seeing the implications in the financial market, and gradually it will translate into the real economy as well. So the way, it will happen is that more and more regional banks and large banks in US will slow down their disbursement growth. The overall growth itself will start coming down, and inflation will also eventually start coming off. And that is very much, visible in the 10-year US Treasury, which has actually corrected quite a lot. So at some point of time, the Fed will pivot and change their stance. But I think till then, we will have to live in this narrative of slowing growth. Within that, we continue to maintain a positive stance on the banking sector. And personally, I think that, post all this crisis, once it settles down, there will be a renewed, I would say, appreciation or an acknowledgement of Indian banking system, and more so the central bank, which has done a commendable job over last couple of years. I think that, the banking sector's growth, although it may come off by, a couple of percentage points, but whole fears of, NIM compression and asset quality issues are overblown. Valuations have come down pretty reasonably. So we continue to maintain a positive stance on banks. In addition, we are also pretty positive on the pharmaceutical sector, because I feel that, with this whole whatever slowdown is happening in US, IT may no longer continue to be a defensive sector, and therefore the growth rates have actually collapsed so far. If you compare it with the pharmaceutical sector, the valuations look pretty reasonable for more or less similar growth. So my sense is that monies should move from IT to pharma as a defensive play, and we continue to maintain positive on banks.
Okay, so positive on banks, positive on pharma. Ajay, hi, good afternoon. Let me ask you about the only area from where we at least get, positive news. And that is a lot of the ordering activity, whether it is defense or it's railways or it is, NHAI. And we see those companies pop every now and then when they announce orders. How are you playing this particular part of the market? Because, stock prices have also moved up quite a bit. So how do you find valuations here? And it's a large amorphous space. I mean, there's defense, there's EPC, you could look at power, you could look at railway, related stocks. So which part of this capex story are you most convinced about?
Sure. So, we always have seen in India that, a particular theme which gets really, attractive and people start looking at a lot of action, they extrapolate that and immediately, the stocks become pretty expensive. So in this whole correction, during this whole correction, cap goods infra is one space which has not corrected, I would say relatively less corrected versus all other sectors. Within this, we are pretty positive on the whole railway capex side. Because eventually, if you look at it, 5 years back, the central government expenditure used to be somewhere around 40,000 crore. That number is now north of 2 trillion rupees. And we are actually seeing a lot of traction across public and private companies where they are getting very large orders. They are setting up capacities to actually meet that requirement. So railway capex is one where we are very positive. And another is the whole, the capex cycle, the private capex cycle. But that actually, if you look at the numbers recently, that has slowed down a bit, considering the global uncertainty and also the domestic, slowdown, what we are seeing on the discretionary side. So that space is seeing some sort of slowdown. But yeah, on the overall, we are positive on the railway capex side.
Ajay, what about the auto space? Now, autos have gone through a very long period of underperformance. Over the last 5 years, I think the Nifty Auto Index has given a CAGR of less than 5% in, low single digits kind of return. And it's majorly underperformed the benchmark indices. And the hope was that, with that pent-up demand, EV push, autos will actually start improving and it's a start of a structural upcycle. But now increasingly people are concerned about this rural slowdown, high cost of ownership, and we are seeing some downgrades coming through. Where do you stand on autos now?
So honestly, Rima, we are not very positive on the auto, and auto has always been a very stock-specific sector. But barring a couple of very bottoms-up ideas, as a whole, we are not very positive. I strongly feel that whatever price hike the sector has seen over the last 2 years, and during the same period we have seen a very high inflation as well. To some extent, and also the whole disruption through the EV, although it has not picked up in a very big way. But my sense is that, rural market, which is the key driver for this whole sector, is yet to see some sort of revival. And till that time, I don't think, we are likely to see this sector doing well. On top of it, there are a couple of players who have significant export exposure as well, which again has taken a huge knock. So, put together the rural slowdown, the export markets not doing well, and the price hike which has taken place over the last 2-3 years, has made the sector a little bit, a little bit on the heavier side. Valuations are still not very cheap, except for the, a couple of two-wheelers which you discussed a few minutes back. But broadly, if you look at it, valuations are still not very cheap.
All right. Ajay, we'll leave it there for today. Thank you very much for your time. It's always a pleasure having you with us here on the program. Thanks indeed. We'll take a break as well, and as always, D Street Chatter comes up next. What are dealing rooms talking about? Nimesh gets us that intel on the other side. What to buy or